Just a couple of months ago, I was getting excited thinking that there was only going to be a month or two left before I was going to crack that $100,000 portfolio goal, which was the whole initial goal of starting this series as I document my journey towards that $100,000 portfolio. And I got really close. I think I got up to something like $95,000. Actually, you can just take a look at the graph here. Yeah, a little over 94,000, but the market can throw a wrench into things. And just in this last month, my portfolio was down almost 11%, a bit over 10%. And this is after it rallied today. I'm filming this as of Friday. We're going into the weekend, and this should be releasing on a Sunday. So there shouldn't be any new action between filming and release. But anyways, it's just interesting to see how violently the market can move both in the up direction and also downwards. Lots of things can happen in the short term. But in this video, I want to talk a bit more about the market pullback, how I'm planning to address this with my portfolio, as well as some of the lessons we can potentially learn. But if you're new to the channel, my name is Jack Duffley, and in this series, I document my stock portfolio on the 15th of every month, and I show you what's happened with the portfolio, any decisions I might be making with it. And I try to always be transparent with my portfolio and what I'm learning along the way because, well, there is a lot to learn with investing, and it's always a learning process. So if you're interested in that sort of thing, be sure to subscribe so you don't miss future episodes. And one other thing I should mention is this platform is called M1 Finance. I always include an affiliate link in the description if you want to check it out. It's got a really nice user interface for stock investing. It's particularly good for longer term investors because it's not really built that well for trading short term or using complex derivatives or options or anything like that. But it can be good just for kind of building a longer term portfolio and paying attention to your allocations as well and building your ideal portfolio. You can actually also copy portfolios as well. I include my own portfolio in the description. It's not financial advice by any means. I'm not saying you should use this exact allocation, but if you want to see my specific holdings, maybe you like an idea in here and you want to add it to your own portfolio, that's something that M1 Finance allows you to do. It's free to open an account, so definitely check it out. I have that affiliate link in the description. But anyways, as I mentioned earlier, I'm down almost 11% on the last month. This is just the last month. That's $10,000 in losses just in the last month. And if we go to the all-time view, we're now almost 20% down. And this is going all the way back to January, late January, really into February of 2020 when I started this portfolio. Now I've added a lot of money really in the past few months, which is why it's stung a bit more than it might have otherwise. Because for a lot of this time, I was in law school and I wasn't earning a full-time salary. So I was investing as much as I could, but I had to be careful. So I didn't want to over leverage myself. And now that I have more money coming in, I've been investing more into this portfolio. But while I'm doing that, the market has been going down. Over the last 52 weeks, the market is down a little bit. And over the last quarter, it's been pretty brutal. Actually, if we go to the quarterly view, yeah, it's down. My portfolio in particular is down about 13%. This is a money-weighted return. But if we go to the daily view, my portfolio is up almost 4%. It was actually a big Friday. So it's just crazy to see the volatility that you can get in the stock market and really in any sort of investment, but definitely in the stock market right now, things are very volatile in both directions, though more often than not, it's been in the downwards direction, but hey, that's going to happen. And in the last month, I have been making some purchases, though because of tax season, I had to tie up some cash by putting it into my HSA, which is not this account, HSA being a health savings account. So I haven't had as much cash to invest over the last month, despite all of the downward movements, which would imply that the stocks I like are getting cheaper. But even though that is the case, I am in a tougher position cash-wise, at least until payday, which I actually was paid today. So I have added another $1,000 or so, which isn't reflected in the cash balance yet, but it is in my buying power. And I'll be adding some more probably over the next week. But I am trying to be a little bit careful. I'm in a weird sort of spot right now because I anticipate having to buy a property. Well, I don't have to, but I'm planning to buy another property in the next 2 to 3 months or so. So I do want to have a little bit of cash set aside just to have some reserves set up. I have talked about on this channel a lot about leveraging this portfolio, which I've done a lot through this borrow feature. I haven't really done it a lot, but I've done it a number of times already where I take out money. I've done it once with a property, I should say, where I actually take out a margin loan against my portfolio. Right now I have up to $34,000 available or so. It's based on the value of the portfolio. I take out this money. I can use it as a down payment, as part of rehab or whatever it is for the property. And then as money comes in through my salary or my other income streams, that will go towards paying this down. So it's a way to stay fully invested or close to fully invested while still being liquid enough to buy some real estate. And that's what I did on my last property, and I would intend to do do it on my next one as well in pretty much any case, though we'll see what actually happens. Everything is always subject to change, including that interest rate, which is variable. So as interest rates go up, this would go up as well. It used to be 2%. Now it's all the way up to 2.75%. So I'd have to be careful. I wouldn't want to hold any margin debt out for a significant period of time because you have that interest rate risk. And you also have the risk of being margin called, which would not be fun, especially since the market is a bit rocky right now and could drop very significantly even from its current levels. And I do want to talk about that in just a second, because you're seeing a lot of headlines like this lately, very negative headlines talking about the lack of hope, how the stock market is in trouble, how there might be a bigger crash coming, and how there are all these things to worry about. It talks about how the Federal Reserve and central banks are hiking interest rates and are going to continue to do that. And they're saying they're going to continue to do that. All these bad negative factors that would theoretically hurt the market and hurt the stock market in particular. That this has become a lot of the focus of the news, especially as inflation continues to run rampant. Central banks have started to not be as dovish, though it's hard to say that they're truly hawkish given the state of inflation in many cases. But regardless, there's a lot of negative news right now. And it is a sort of weird feedback loop in that if enough people get scared, they start to sell. And then all of a sudden, the people who are predicting that things were going to be bad are correct because they sort of encouraged people to sell or to do whatever they were saying was going to happen. So it's this sort of self-fulfilling prophecy to some extent, though I shouldn't give the media too much credit because people are the ones who ultimately hit the sell or the buy button. The actual investors are. Though I guess algorithms might make a significant portion of the trading volume in a given day through high frequency trading and market makers and all that stuff, but that's kind of beyond the scope of this. Well, let's put this monster dip into perspective. Here's the year-to-date view on SPY, the S&P 500 ETF, and you can see that year to date, we're down about 16%. That's a significant drop. Pretty much any way you spin it, that is a significant downturn. But what if we zoom out a bit? Go back 1 year. Okay, the market is down about 3.5%. That's not all that great. You would like to see growth over the long term, especially over a year or beyond a year, though a year really isn't that long in the stock market. So let's zoom out a bit further and we go back to the 5-year view. Okay, we're still up about 70% over the last 5 years. If we actually go back to the depths of the March pullback with the start of the pandemic and all the bad things associated with that, well, the markets were in a panic then, and look where they've ended up. Still up about 75% since those March 2020 lows. It's been about 2 years since then, and the market has surged even after you take the recent pullback into consideration. Now, I'm not saying that the market can't go further down. Of course it can. It could go all the way past this March 2020 recent low from just a couple of years ago. It could go well below that if we get a massive crash, which could happen. But at the same time, we could also get a reversal if the Federal Reserve changes course and starts doing massive quantitative easing again, lowers rates again by a couple points, or I guess really by the 0.75 points that they've raised it by, since they're really still not that far up above zero. But if you get a reverse in course, all of a sudden people might become more optimistic, at least investors would, and then you'd see a surge back up because it's just very hard to predict things in the short term. Look what happened just at the beginning of 2022. We saw a pretty significant dip of about 10%. That was followed by a spike up in about 8% from March into April. And then that was followed by the more recent dip we've had of about 10%. You can see that it zigzags up and down. That's what the stock market does in the short term, at least a lot of the time. Sometimes it might be flatter than other times, but it's just very hard to predict anything here because it's so sentiment based. And that's where the opportunity lies. So in my own portfolio, if we go back to the invest view, I'm trying to find companies that are at a discount to their intrinsic value, or at least what I think the intrinsic value is. It's more of an art than a science, and it's really up for you to decide what the value of a business is. But lately, I've been adding money to a few holdings. I'm going to leave it on the daily view so you see all the green, but if we go to the all-time view, my value slice isn't doing all too hot since I started this. This is most of my individual stock picks, and well, they haven't done too well. My first one ever, though, has done quite well, and that was CVS. This was with not very much money, and it kind of ran up pretty quickly after I bought it, and I've just held it since. But anyways, pretty much every pick after that has been pretty brutal, at least within this slice. And my biggest one being Turtle Beach has really fallen in the recent month, really fallen all the way down to about 15 as of yesterday, and now it's jumped back up 10%. What a great day. It's up 10% after falling like 20% over the last week or two. So, that's just the nature of the game with individual stock picks. And because you have a less diverse portfolio, the chances are you're going to have a lot more volatility because you have less to smooth things out. Because when you have a more diversified portfolio, you have more winners, but also more losers. And you should get more of that smoother trend line that you see with the broader market, since you're basically becoming an index at that point when you have a ton of diversified holdings. That is not what my portfolio is. It's quite concentrated, at least compared to the average investor. I have something like 20 holdings in here, though some of them are more index oriented. This Berkshire holding is very diversified. It's got a ton of holdings. Then again, Apple makes up like half the portfolio within that. So this is almost like an Apple position. If you want to look at it that way, at least half of it, half of the value, you could say you could chalk it up to Apple. Within big tech, I have been looking to add more to Facebook. I've added more to Alibaba. I don't really want to get beyond this current weighting. Now, if my portfolio grows a bit more, I might add a bit more, but unless it drops even more from here, I'm just not too interested in adding more. I've got a decent amount of China exposure in my 401k as well, which has a lot of emerging market ETFs in there. It's a big weighting in that. So I have some pretty broad exposure to China, and it's at a level that I'm comfortable with. If it goes beyond that, I might get a little bit more uncomfortable, though we'll see. This is kind of a moving target, I suppose, with the regulatory risks and the sort of sentiment between the governments of China and the US, also the Chinese government. There's a lot of factors here that I'm not totally comfortable with, and that could always change, of course, but as of today, I don't really want to add too much more to Alibaba, even though it is well below my cost basis. And I was adding it pretty much all the way down since I started buying it in the high hundreds. Now it's down to like $80. So just a crazy drop there. Facebook is one, or Meta Platforms, it hasn't changed the name here on M1. This is one I've been trying to add as it gets closer to 180, but it keeps jumping back up to about 200. I've been buying a bit towards 180. I initially bought in the like mid twos well before kind of the metaverse news. It's kind of an older position that I've since built out very recently. You can see kind of the spike up here. I really started funding it a lot more in February. This is a holding I would like to build out more. It's a cash flow machine. I'm pretty bullish on it long term. Not that I think it's going to grow by leaps and bounds, but even if it grows just a tiny bit, it's throwing off so much cash. As long as it doesn't shrink, I think it could do well, but hey, time will tell. You never know when the multiple is just going to shrink like it has in the recent few months. But I'm going to keep a close eye on this one. I think over the last month, I added almost $2,000 to this position, so nearly doubling it. And I'd say a full position for me in this portfolio would probably be about a $10,000 at cost, at least given the current sizing. That would go up as the portfolio goes up. Probably 10% is kind of what I'd consider a full position. Maybe 15% if I'm particularly bullish or if I think it's a really good price. But something around there is probably what I'm aiming for most of the time, though it's not really a hard and fast rule. Anyways, back to the general portfolio. If we look at metals over here, this is kind of my commodities slice. This has done actually quite poorly in the last month, if I'm not mistaken. Yeah, very poorly. Most of these holdings are down about 25% just in the last month. And this is during what you would have thought would have been a really bullish time for commodities with the whole crisis in Ukraine and the global supply chain issues. Commodities have done actually very well, at least in the last quarter. I think it's, pretty close to flat on the last quarter, which I wouldn't say that close to flat. It's been pretty bad just because of this last month. Huge pullbacks in commodities, though this was after a pretty substantial run up over the last year and a half, where commodities have done very well, especially with all the money printing, the interest rate cuts that we had for a while. Now they're turning into interest rate hikes, and people are starting to flee commodities, which is very interesting. It just shows you how sensitive pretty much all equities are to interest rate changes, because there's so much debt in the system. It really determines the purchasing power for businesses and individuals alike, and that's going to go to commodities as well, the components that make up lots of things. It all is part of the same sort of underlying system with the amount of debt we have in the system. But in any event, it hasn't been a kind month for commodities either. So what do we make of all this? Well, as I mentioned before, volatility is part of the game with stocks. We've had a lot of favorable volatility, and that it's been very positive as of the last couple of years. Since that March 2020 low, it's been almost a straight ride up since then, and a very substantial ride up at that. But now we're seeing a bit of a pullback, and people are worried, and that fear could compound on itself and lead to an even greater downturn. Though, hey, we had some optimism apparently today, and a bunch of people poured back in, buying the dip, I suppose. And all I'm trying to focus on, as I've reiterated many times before, I'm trying to build this portfolio up. So I'm not trying to exit the market. I have a lot more money coming to fund this portfolio. That is the plan over the next few years, really for the foreseeable future. I don't even know how many years out I'm going to continue to fund this with new money. Eventually, you would like to think that the portfolio returns and dividends themselves would fund the portfolio. But for now, I'm bringing in a lot of outside money, my salary, other investments, my real estate income. A lot of it is being poured into this. And that's going to continue to be the case until I get this up to a size where it's really moving the needle. Right now, yeah, this sucks. I lost $10,000 in a month, which doesn't look good on paper. It doesn't look good for the M1 Finance update, I suppose. But it's part of the game and it's to be expected. And yes, it's a $10,000 loss, but I can make this up in a fairly short period of time. It's not as though this is going to take me 10 years to make up. I'm adding thousands of dollars every single month. So it's going to be replaced at some point pretty soon. And again, it's annoying, at least on paper, but you could also say it's great because now I'm getting a discount on the stocks that I like that are now at a cheaper price. Though it can be very hard when investing in stocks to not get caught up both in the euphoria and in the pessimism and negativity when you get into harder times, because that's really where the opportunity is. When you can get in during pessimistic times, you can buy low, and then you can sell or at least ride those gains up and do whatever you want with them during euphoric or optimistic times. That's really the nature of the game, especially when it comes to value investing, where you're really paying attention to company valuation and trying to get a good deal for whatever it is you're buying, and also getting a good deal for whatever it is you're selling. You're not really buying on hype, but rather you're buying on fundamentals. At least that's how I am doing it. Or maybe I should say that's how I think I'm doing it. Time will tell. Anyways, I'd love to hear what you guys are doing in this crazy market, so be sure to comment below, like, comment, subscribe, all that fantastic stuff. Check out the affiliate links in the description below. But until next time, take care.